We are in the Scholar series for BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So follow the video till the end. Also follow the complete series. Okay. Share it with your friends. Share it on all your social media platforms. In fact, subscribe to the channel first. Okay. Click on the bell icon. Okay. Let's start. First one. Sure, it's a series. If you watch the question number, it's starting from long back. So that's why I say watch the complete series. Which of the components of the bank's balance sheet is not included in the liabilities? Not included. Okay. Inter-office arrangements, adjustments, provision of income tax, overdrafts, and capital. So not included in the liability. Which of them is not included? Huh? Remember this question. Not. You have to always focus on what is and what is not. Whether you want a true answer or whether you want the wrong answer. So the answer is everyone. Let me first cover some details. Not included in liabilities. So what are liabilities basically for any company or any bank, you can say. Liabilities means which we have to pay. Okay. Inter-office adjustments. So these are what basically. Inter-office adjustments means within the branches some adjustments. So it can be over there or within the banks also any adjustment. Provision for income tax. So liability means I have to pay. So this I have to pay, right? Overdraft. Now what is overdraft? This is something important. What is overdraft? Overdraft is a loan. It's a bank product. Okay. So how can it be included in the liabilities? Overdraft is a loan. What are loans in the banking system? Type in the comment section. What are loans in the banking system? Are they liabilities or assets? Right? So ODs are repayable on demand, though there may be specific due date also. They are shown on the asset side of the bank's balance sheet. These are the assets. Okay. So these are not liabilities. Remaining things, this capital, inter-office, and all these are provisions. That is, these are all liabilities. So the basic answer over here is it is OD. Okay, it's an asset. Which of the following is not one of the Basel framework's way of calculating credit risk? Not. Okay, not. So you want false. Remember. Okay. Value at risk approach, standardized approach, foundation internal rating based approach, and advanced internal rating based approach. Not one of the Basel frameworks way of calculating credit risk. Huh? We are focusing on credit risk over here. So what is the answer? So before giving the answer, again I'll give you the explanation first. Basel framework we are talking of. So Basel 2 or Basel 3, anything, both of them. They are basically, it gives banks ways to assess the capital needs. Okay, capital needs based on the credit risk. Credit risk, not only credit risk, it's credit, market, and ops risk. All the three risks are included in this Basel 3, right? So our question over here is for credit risk only. Now the two approaches for credit risk are basically standardized and IRB. Standardized and IRB. Then you'll say IRB. Yeah, IRB means internal rating based. Now this IRB is further divided into two parts, FIRB and AIRB. So this credit risk basically will be dealing in what? This is credit. This is for measuring the credit risk. This is for measuring the credit risk, and this is for measuring the credit risk. So what is this for then? Value at risk. This is the real answer, not the way. But what is this for? This is for measuring the market risk. Remember, market. Okay. All these three approaches, standardized or FIRB or AIRB. Okay, these three. So under this standardized approach, look at this. What do? The rating is given by the external agencies. Okay, based on the ratings of the external agencies. So bank will depend on those external agencies ratings. In FIRB approach, what happens? Under FIRB approach, the ratings will be given by the bank. Okay, but the fundamentals of that, or the parameters of that, or the feed for that will be provided by RBI under FIRB. What about by AIRB? Under AIRB, all the things will be decided by the bank, and that is the ideal way. That is the ideal way. Okay. So banks model this under this FIRB, basically banks model only probability of default, while in AIRB they can calculate loss given default, exposure at default, means basically everything. Why? Because the parameters are given by the bank only under AIRB. Okay. So the answer is VAR, value at risk approach. Which of the following is not one of the Basel II framework's techniques for calculating the operations risks? Now this you can consider Basel 2 and 3 also. 3 also no change in this. Also only one word enhanced is added, otherwise everything is same. Okay. So which of them is not the Basel 2 framework for calculating the operations risk? Basic indicator approach, standardized approach, advanced measurement approach, and FIRB, foundation internal rating based approach. Just now we saw it, right? What did we say about this credit risk? Credit risk was FIRB also, right? So if this FIRB is for credit, is it used for operations also? So not the one is not. Look at. So the answer is D, FIRB, that is for credit. Okay. All these three are for ops. Okay, ops risk. Now let me give you some idea about this. Okay. These are the three basic methods: basic indicator, standardized, and AMA. Okay. Under basically this BI, basic indicator approach, we have a alpha factor. That alpha factor is always taken as 15%. Okay. And we take average gross profit under basic indicator. Average gross profit for 3 years. Okay. So that is basically this basic indicator. Whereas in standardized, we have 3 percentages. What are the 3 percentages? They are 12, 15, and 18. Banks are divided into various categories. Categories means various segments. It can be retail banking, it can be retail brokerage, it can be this commercial banking, it can be corporate banking, agency services, all these, and these are given various ratings. Retail comes under 12%, corporate comes under 18%. Okay, and this commercial banks, this agency service comes under 15%. So these are all the percentages under the standardized approach. And under AMA approach, see this AMA means what? It's again related to the bank, completely done by the bank. So under AMA approach, banks can create their own models to quantify this credit risk, operations risk. Okay, it uses 4 quantitative elements. Which are those? Internal loss data, external data, scenario, and business environment analysis. So these are the 4 parameters used under AMA. And internal control factors for the methodologies such as internal measurement approach, IMA, and loss distribution. So these all methods are used under AMA. Okay. So for operations risk, remember there are 3 methods. Got it? Okay. Next one. Which of the following is an important factor for limited hedging of operational risk? Limited hedging. What do you mean by limited hedging? Controlled hedging. Limited means controlled. Controlled. Okay. Limited to a certain limit. Absence of commercial vendor to sell operations risk data. Operational risk process correlations are fixed and known to the buyers and sellers. Operational risk assessment is objective and rigid. Identifying operational risk accurately that are not yet apparent in the competitive task. So which of them is used as a limited hedging? Okay, limited hedging. Let's look at it. So the answer is, okay, before coming to this answer, let me give you the first some